Yes, you can be on mute, right? And when you have questions, you can just unmute yourself and ask. So basically, in the last class, we started talking about the different kind of. We were actually talking about the different kind of products, and in respect of each of the products, we were trying to understand that what are the products like, right? And then, given that given that we understand,
Sir,
yeah.
before starting the class, I would like to discuss a few things.
Just hold on. Just hold on. Okay, so as we had started discussing about it, like the behavior scorecards. So basically, our approach was we started off discussing about different kind of products, and within those products, we started exploring the different kind of models or the different areas where the models would begin, or the different areas where the models would actually be would be developed. So one of the parts that we had seen was that we had this model. So we started exploring the credit cards as a business product. We saw what its different characteristics were, and from there, what we did was we had this behavior. So we saw that one area where scorecards could be developed is the application scorecard. The second area that we saw was the behavior scorecard, right? So when I talk about the when we had completed a more or less a discussion of application scorecard where we had talked about the different the through the door population, the accepted base, the rejected base, and so on, right? And the next set of things that we had done over there was we had discussed about, or we went to discuss about the account management strategies, right? So account monitoring, account activation, and stuff like that. So today's focus what we would have is on the behavior scorecards, right? So when I talk about behavior scorecards, we have this account. So basically, first let so we started discussing what exactly does the behavior scorecards do. So let us think about it from this perspective that there is a you know so the borrower or an applicant has been given the credit. Now this applicant is on the books of the bank. Now given that this borrower is on the books of the bank, he is making a payment of his EMIs, as you might call, or whatever it is, on a monthly basis, right? So every month what this guy does is this guy is making his payments. Now, from the part of the bank needs to monitor the payment patterns of this particular person. So it is very important that we realize that how this payment is to be done, or how good or how bad the borrower is in paying back his funds or paying back his outstanding funds. So over here, so that is the part of account management. So once an account is on the books of the bank, how good or how bad the account is in managing the funds, that is what we call account management. Now within account management, as we had discussed, there are a lot of different activities that goes around. So one is obviously account monitoring. The second is account activation. The third is the account limit. So basically what I do is I take up account monitoring. So within account monitoring, what I try to monitor is the purchase, the purchase pattern of the borrower, the payment pattern of the borrower, the delinquency patterns, and so on. Then what we have is the account activation. So within account activation, what we have is say whether a particular so there can be a case where a guy has taken a credit card, but he has not been paying back his funds regularly, or he has not used his funds ever. So he is an inactive account in the books of the bank. So that is where the part of account activation comes in. So it is also a part of the account management strategy team to understand why a particular account is inactive, and how is it that I can, or what treatments or what incentives can I actually give to this guy so that this guy starts using his card. The second is, or the third part is identifying the account limits. So basically, I have a limit with my credit card. So whenever a credit card is issued, I have a pre-approved credit to it, right? So once I have this pre-approved credit, the next part that we need to know is the secondary lines of credit. So it might be that should I be giving this borrower a credit limit increase? Should I be giving this borrower a credit limit decrease? So on what parameter should this limit increase be given, or on what parameter should this limit decrease be given? That is what we need to clearly assess, right? So these are some different activities which lie within the account management, the account management activities, or which fall within the account management activities. Now when I say that these are the stuff which fall under account management activities, what we do is, so therefore what we are trying to do over here is we are trying to assess the behavior of the account. So broadly, under account management, we are trying to assess the behavior of the account. And when we are trying to assess the behavior of the account, what we are essentially doing is we are trying to assess the relative source of riskiness. So there is a borrower A and there is a borrower B. By managing the accounts, by to performing the different actions of account management, what we are trying to understand is, what we are trying to assess is that is borrower A relatively more risky than borrower B, right? So this is precisely the objective of account management. Now the next part that I have over here is the willingness to pay back. So basically, when I want to assess the relative riskiness of the borrowers, how do I do that? So to do that, I need to assess the willingness of the borrower to pay back. Now, the more willing a borrower or a a obligor is willing to pay back his credits, right? The better off is he as a borrower, right? So, and the lower the willingness of the borrower to pay back his credit, the more riskier is he, right? So the objective of any, for indeed any product, right, at the behavior stage of the customer's credit life cycle, the objective of the analyst, or the objective of the banker, is to identify the willingness of the borrower to pay back his debts. So lower the willingness to pay back, higher are the chances of default, and higher the chances of default, lower are the willingness of the borrower to pay back the dues. So given this, so the question that comes out is that how is it that I can actually capture this willingness to pay back? And if I want to capture this willingness to pay back, what I need to also assess is the riskiness of the borrower. So how risky is a borrower? What are the core sources of risk? From what are the core sources from which riskiness arises? Right? Now, when I talk about credit cards, talking about credit cards, especially as a product, the riskiness arises from two sources. One is a drawn limit, and the second is an undrawn limit, right? So, over here, what I need to know is that, so there are these two sources. One is a drawn limit, and the second is an undrawn limit. And from this, and the riskiness for a credit card can arise from both these sources. So the question that comes out to me is that how is it that I can actually capture the riskiness of a borrower Or how is it that I can capture the willingness of a borrower to pay back at a given stage? So this is what is riskiness. And there are these two broad sources of riskiness. One is a drawn limit, and the second is an undrawn limit. So before we move into understand that how is it we can capture the riskiness from these two sources, let us try and understand that what are these two concepts. So basically we have discussed that there are two sources, or there are two very important components which define a credit card as a lending product. So one of the component that we have over there is the limit, right? And the other that we have over here is the balance, right? So the limit is the amount of limit which has been assigned, or the line of credit that has been assigned to your card. It is the line of credit assigned to your cards. So basically what it is that there is this borrower, right? So there is this borrower which is so so LOC, so the line of credit which has been assigned, right? So I take up a card which has a limit of say 20,000 assigned to me. So I can use credit up to 20,000. And the balance is the exact amount outstanding. So the balance over here is the actual outstanding, right? So one is the limit, the other is the balance. So over here in the first case is the limit outstanding. Limit is the line of credit which has been assigned to a borrower, and the second is the balance, which is the actual amount outstanding. So this is what the two idea is. Now, out of this, the balance is your drawn limit. So this is the amount of limit which you have actually used up in your card, and that is why this is the balance which is outstanding. Right? So there is this balance which is outstanding. Or as I can say, this is your drawn limit. Say suppose out of the limit which has been assigned to me as 20,000, out of that, what I have done is I have used 12,000 of my limit. So my balance outstanding is 12,000. So say my limit is 20k, and my balance outstanding is 12k. My balance outstanding is 12k, right? So that means the headroom or the undrawn limit is balance limit minus balance. This is limit minus the balance, which is 8,000. So this 8,000 is nothing but the limit of the balance which is outstanding, or your undrawn limit. Now say I am a borrower who defaults, right? And with this 12,000, I what I do is I just go ahead and I default, right? I just go ahead and I default, right? Now with 12,000 outstanding when I default, right? Now the riskiness is not only arising from this 12,000. There can be, So just before default date, I can actually withdraw this undrawn balance, and then with the entire 20,000 I might go into default. So I may draw that, I may not draw that. But once I draw that, I just draw it and then I go into default. Therefore, for a revolving product, riskiness not only arises from the balance, but it also arises from the headroom. Therefore, when we are trying to model the EAT models, or whenever we are trying to develop PD or EAT models or behavior scorecards for a revolving product, we need to ensure that the variables that we are using capture not only the drawn limit, but it also captures the undrawn limit, right? And that is the reason where, that is the part where these the concept of this primary and derived variables come in, right? So up to this point, is it clear, Harpreet?
Yes, it is clear.
Great. Now, having said that, the next part that we go into is, so what are these variables? So what is a variable? For be it in a behavior scorecard model or things like this. So variables reflect the drivers. Variables are nothing but it reflects the drivers of the risk. They are risk drivers. Now, what are the different type of variables that we have, and what is the primary and this derived variable that I am actually talking about? So, how do they impact, or how is it that I can actually relate the concept of risk driver to the willingness to pay back? So basically, when I talk about a risk driver, uh, so what is this risk driver that I'm talking about? So over here, you would see that. Uh, so a risk driver will be a very important or a significant variable which affects the riskiness of the borrowers. Now let's see what are the basic risk drivers. Obviously, one of the risk driver, one very important variable for a credit card will be the balance outstanding. Also, another variable will be the limit. The third variable that becomes important over here is, again, obviously, as we had discussed, a delinquency variable. So, what is this concept of delinquency? So, delinquency is an event where you have missed out your payments on, so you have not actually defaulted, so you have just missed out paying an installment, right? So, so there is a credit card bill which is generated for a cycle, and you miss out paying the bill for a given cycle. Then what we have is we get this variable of delinquency. So we say that this guy has missed out paying this bill for one cycle, and hence he or she is one cycle delinquent, right? Now delinquency is a very critical variable for you know for a credit card. Now let's look into the different kind of variables that we can frame from this which can help us assess this willingness to pay back. Okay, another important variable that we have is payments. Payments. So the amount of payments that a guy is actually making in a cycle. So that is what is payments. So over here we know that uh, so let's talk about balance first, or let's talk about limit. Say there are two borrowers, right? So there is borrower one and there is borrower two. Now borrower one has a limit of 1 lakh and borrower two has a limit of, this is called L2 and this is called L1, has a limit of 50. Now, by looking into this limit, can I say that borrower 1 is more risky for the bank compared to borrower 2? By looking into this sole primary variable, can I make an insight, right? So can I make an insight
No,
about the riskiness of the borrower? But
no,
okay, so we cannot. Why? Because I can see that this guy has been given the loan. This guy has been given a higher credit limit of 1 lakh, but it might be because he deserves that 1 lakh. He might have a higher income, and but going by all the factors, the bank might have considered him to be a good borrower, and he has given. So basically, by this, the conclusion that I can make is that borrower one has a greater affordability and the reliability for getting 1 lakh, whereas borrower two has that up to 60,000. Now, once this is done, the next thing that I look into is the balance. So the balance for borrower one is say 80,000, and the balance for borrower two is 48,000. So this is what the idea is. Now, by looking into the utilization, can I say that borrower one is more risky than borrower two? Now, perhaps by looking into the figures, I might conclude that borrower one is more risky because he's spending more. But to use them, but to analyze the behavior, what we need to have is the, or what we use is a derived variable called utilization. So utilization will actually give me an idea about the balance that the guy has relative to the limit. So obviously I can say that his utilization is zero point 0.8 or 80%. So it is zero point 0.8. Similarly, for the second guy, it is 48 by 60, which is again yes, which is 80%. So both these guys have the same level of utilization. Now, by looking into this, so when I use this utilization, the utilization is a variable which is derived from borrower one, and I mean which is derived from the limit and the balance of both the borrowers. However, if I look into this behavior, right? So both of them, as on a given month, has utilizations of 80%. However, that need not always mean that both the borrowers have throughout have had an utilization of 80%. So the next thing that we need to do is we need to understand, to frame an understanding of the riskiness of the borrowers. We need to understand their overall level of utilization or their trend of utilization, say over the last 12 months, over the last 24 months, something like that basis on the vintage of the data that I have with me. So what I'll do is for both these borrowers, I'll perhaps I will generate a trend, a trend of the graph, right? So I'll generate a trend of this particular graph. So this is for borrower one. This is what the utilization pattern has, right? So he has been maintaining more or less a similar kind of an utilization. Now the second type of graph that I'll have is say, so if you have, say this is one, say borrower one, and this is borrower two. Now, what I can see is that there has been instances where the utilization has been more or less similar, but the average usage of the average utilization of this guy borrower one has been relatively higher compared to that of borrower two. So over here, what we have is this. So this part and this part represent where the utilization has been same in 2 months, but for the others, it has been more or less similar. So, I mean, the other periods, borrower one have had a higher utilization. So by looking into this graph up to this point, all I can see is that borrower one on an average has a higher utilization than borrower two. But that does not necessarily mean that borrower 2 is more risky or borrower 1 is more risky than borrower 2. It might be that this guy has a higher average utilization and hence he might be a very prized customer for the bank. Now to assess whether the borrower whether borrower 1 or borrower 2 is whether they are who is more risky, I also need to look into not only the billing side of the story but also into the payment side of the story. So how much of the balance outstanding do these two borrowers pay back on a regular basis? So that is where we bring in the concept of payments. So say the first borrower pays back 60,000 and the second borrower pays back 36,000. So does this always mean that this borrower A is a lower risk customer? So to understand that, what we need to do is we need to look into something called the payment balance ratio. This is called the payment balance ratio or the average payment balance ratio.
Okay.
So when I talk about
Okay. So I have a question.
yeah,
Uh, s- uh, this is a behavior. behavioral variables like balance, limit, delinquency, and payment. I just want to know, have you derived these, or these are mostly fixed for fixed
No, no.
products,
These are
or we can
these,
have more?
no, no. We can have more variables, obviously, but every
Okay.
product has a set of core variables. Okay, and they are all
Okay.
primary variables. So
Okay.
balance, limit, payment. So these are directly fetched from the account level information, right? And
Mm-hmm.
then
Okay.
what I'm doing
Yes.
is I'm using them to create further variables, which will help me capture the willingness of the borrower to pay back,
Okay.
right?
Got it.
Okay. So basically, for credit cards, when this question came up, Harpreet, just let me clarify that for credit cards, there are two types of data that are generated, two types of files generally that are generated. One file which contains all billing information, so the bills that has been generated, right? So it contains the balance that has been used, the transactions that has been done, the purchases which has been done, the merchandises where it has been used. From there you have the payment fee, the fees if anything charged, late fees, etc., etc. And from there, what happens is in the next part, what you try working around with is, or the second set of data that you generally get is the payment behavior. So, how much has the person paid back on a given date? What was the minimum amount due which was given to him? Did he pay back the minimum amount, or he paid back the exact amount? Right. So whether what was the date he paid, what was the date when the bill was outstanding, and these records are available on a month-on-month basis for the entire portfolio. So when you are developing a model, you take the information from the payment files, you take the information from the billing files, you pull them together, you create your master data, and from there you create all these variables, and then you go ahead. So this is how it works, right? And when we are creating these variables, there are all, so we can create different variations of these basic variables. So I'm just first talking about the basic variables to be created, and from there we'll talk about the variations of them as well, and we'll see how each of these variables will help us capture the different aspects of the riskiness of a borrower, right? There is payment balance ratio that I have over here. So there is balance and there is payment. Great. There is balance and that there is payments. Now what I do is I draw another graph. So now this payment balance ratio can be charted out on a month on month basis. So let's take this for borrower 1, right? So for borrower 1, what I see is this borrower 1 roughly uses, this is say for this borrower 1, this is the payment that the utilization that he does for borrower 1. And the payment that he makes is more or less like this. It's more or less a straight line. So what I can see is that for this particular guy, there is so his consumption or his utilization has been relatively higher throughout compared with his uh, utilization that has been there, right? Now, after this, the next part that we talk about is for the second person. So let us, so for this is for the second person, we are just drawing another graph. See, this is the in consumption for the second person. Now, the payment balance ratio that this guy also has is, so what I can see over here is that the amount that he is using up, this guy, is also paying back similar amount. So however, this must not go above the payment balance curve, right? So basically what happens is you'll get to see that yes, this guy is paying back much. So whatever he's using, he's relatively paying back more or less the entire amount or something close to the entire amount that he has used up. Therefore, for this guy, for the second one, for the borrower 2, I can say that this borrower 2 has a higher willingness to pay back or has had displayed a higher willingness to pay back over the years, over the months, compared to borrower 1. So borrower 1 has been using the card and he has been always paying back a fixed amount. Say, basically, he has always been paying back more or less the 60% of the total amount that he has used up. But from this perspective, I can actually say that borrower 1 has a relatively lower willingness to pay back compared to borrower 2. So this is what the basic idea is. So when I compare both the usage and the payment patterns together, what I get to see is that yes, this borrower has used up his cards or has used his products very, I mean, he's using his product more diligently than others. Clear? So by this kind of an analysis, so basically when we are actually doing it on the data, we will be actually performing this kind of analysis to frame an idea about the relative riskiness of the borrowers. Right? Great. Now the question that comes out is that okay, I say that this guy has a more willingness to pay back, and this guy has a B1, and the first borrower has a relatively lower willingness to pay back. But does that necessarily mean that borrower 1 is more risky than borrower 2 or vice versa? So to do that, we or to assess the relative riskiness of the borrowers, right? Willingness to pay is one metric, and another very important metric that is looked into is the delinquency variable. Delinquency is a behavioral trait. So basically, if I have missed out paying back, or if I have missed out paying my installments on my credit card payment, then I am a delinquent borrower, right? So I have been delinquent, and this delinquency is reflected in different cases. So this delinquency is reflected through different factors, through different phases. And that is where this concept of delinquency becomes so very important for us. So basically, a guy who has never missed out payment is a more diligent borrower than a guy who has missed out his payments once or more in a given year over a given time period. So if I have missed out payments multiple number of times, say over the last 12 months, there have been 3 instances where I have missed out payment. It shows that I am a borrower who has a relatively lower willingness to pay back than the guy who has made the payments diligently every month. So that is how this part is structured, and that is why delinquency variables are very important to assess the behavior risk of a borrower. So delinquency, right? So delinquency is a very important behavioral variable, and hence is also used for segmentation purposes. is a very important behavior variable and is used for and is one of the most important segmentation variables. A very important segmentation. So basically, we saw that when we were talking about the acquisition scorecard, we said that there can be different variables like OD segment, non-OD segment, current segment, non-current segment, or there can be variables like you can have different characteristics or different character traits like very important. So you can have variables like relationship, non-relationship segments, and so on. So there are these different kinds of segments, or these different kind of variables which are there. So those are different segmentation variables, and we said that when we saw that why are they used as segmentation variables? Because the acquisition risk differs significantly across these different categories, right? On the other hand, what we saw was that the behavior variable. So on the other hand, what we can see is when we are trying to assess behavior risk, there delinquency variable becomes very important, right? So it's a very important segmentation variable, very important segmentation variable, right? So this is what the other part is. So for delinquency variable, this is a very important the delinquency is a very important segmentation variable, right? Now when I have done this, or when we say this, so the next part that comes to us is why is it that delinquency is to be treated as a segmentation variable for a behavior scorecard? So let us think about as on a given day. Let's think about from a very predictive perspective, right? Let's forget any kind of modeling or any kind of predictive models, any kind of variables or anything. Just suppose I'm just standing today. Today is the 23rd of the 28th of March, right? Today is the 28th of March. So today is the 28th of March, right? And you are given 100 accounts, and you are asked to divide them into more risky and less risky accounts. So you have to divide them into two groups, and you are not given any other variable. Then how would you frame your understanding? How would you frame your expectation of who is a borrower, who is a more risky, and who is a less risky borrower? So all the thing that you will see is that as on that date, so as on today, out of the 100 accounts, how many accounts are already delinquent till today? So if an account standing today is delinquent, and there is an account standing today is non-delinquent, so what is the idea that you frame? And given that delinquency is the only criteria, so all you can say is that, man, since this guy has already been delinquent, I believe that this guy is more risky than the guy who has not been delinquent. So standing today, I see that out of 100 accounts, there are 92 accounts which are non-delinquent and 8 accounts which are delinquent. So I will say that, okay, these 8 accounts are relatively more risky than the remaining 92 accounts, because these 8 accounts standing today is already delinquent. So now if they are delinquent today, there is always a higher chance that these guys may go and they would default in the next 2-3 months. So, and the guys who are not delinquent today, they are obviously, they have a higher willingness to pay back, and they are paying back the money in time, and that is why they are not delinquent, and these guys are not paying back the money, and hence their willingness to pay back, or the relative willingness to pay back, is relatively lower than the other 92 guys. Therefore, this delinquency behavior, just by looking at delinquency behavior, we can actually frame an idea that who are the relatively more risky borrowers and the borrowers who are not relatively more risky. So, as on a given month, if I do not have any other variable, just by looking into the delinquency variable, I can make an idea that who is more risky and who is less risky, right? And that is the reason why delinquency variables are treated to be a very important variable from the modeling perspective,
Okay, got it.
right? Great. So therefore, to capture, to capture the riskiness of a borrower, or to identify that who has a higher willingness to pay, lower willingness to pay, different kind of delinquency variables or variations or different types of delinquency variables are used to frame an idea. So basically, one of the ways is uh, the percentage of months, percentage of delinquency, percentage of delinquency in the last 12 months. So in the last 12 months, how many times, or say the percentage of times the customer or the account has been delinquent in the last 12 months. So if I use this variable to predict the the riskiness of the borrower, then I can actually tell you that okay, for the last 12 months, borrower A has been delinquent once, he missed out his payment just for one cycle, whereas borrower 2 had missed out his payments 4 times. So that means the the percentage of time this borrower 1 has been delinquent is 1 by 12, whereas the other person has been delinquent nearly 33% of the time, and that is where this problem actually comes up, right? So a person who has been delinquent over the last 12 months, right, for the last 12 months is one such that, or is a borrower such that, you know this borrower has been on, I mean, the borrower who is relatively more risky. So the percentage of delinquency in the last 12 months. So a borrower who has been delinquent for a higher number of months is, or has been delinquent for more number of months, is called, I mean, is a relatively more risky borrower, right? The logic is very simple. If I have missed out payments more number of times, it means I am relatively more casual borrower, and I have a relative willingness to, I have relatively a low willingness to pay back my loans, right? Great. Now there are other such, there are many other variables, and you can actually create multiple variables out of this, like say the maximum payment that the guy has made over the last 12 months, or say the average utilization in the last 3 months, average utilization in the last 6 months, and then what you do is you take a difference of the average utilization in the last 3 months minus average utilization in the last 6 months. Like this, so you can actually, what you can do is you can always play around the different variables, right? So there are multiple ways the variables can be created, right? So there can be maximum of the variables which can be created, maximum, or So I can create utilization this month, utilization last month, last 2 months, last 3 months, like this, right? And then average utilization in the last 3 months, average utilization over the last 6 months, percentage change of average utilization from the last 6 months to the 3 months, and how has this percentage changed over the last 12 months. So there are different ways in which I can actually calculate the different aspects of the utilization. Right. So now the question that comes out over here is that I am doing a behavior modeling and I am trying to understand the probability of the borrower to default or not. But why am I trying to do that? What is my business requirement? How do I manage? What is the risk management strategy that I'll have behind doing this? So this is where the concept of risk management strategy needs to be discussed. This is where I need to talk about the risk management strategy. So when I talk about the risk management strategy, right? So what happens over here is the following. Uh, so so where is this behavior scorecard actually used? So one major part where this scorecard is actually used is in strategies, in credit limit strategies. So basically, to give a credit limit increase or in getting a credit limit decrease, in having a credit limit increase or in having a giving a borrower a credit limit decrease, behavior scores are used as an input, right? So this is where we need to, or this is one area where we can focus on the risk management strategies. So how does behavior score, or I mean, how is behavior score used in getting this risk management strategies done? So basically, I want to give a credit limit increase to a guy. Now, I have say 1,000 borrowers who are already on the books, on my books, and are actually paying back the money, and they are in the process of paying repayment, etc. The question that comes out is that how do I manage that? Right. Uh, Over here, uh, you would see that. So basically, I want to know that who are the borrowers to whom I'll give the credit limit increase. Now, what is a credit limit increase? So from the name, we can understand that I started off with a limit of 20,000, right? Now the bank wants to give me a limit increase. Now, why will the bank give me a limit increase? So over here, when the bank is deciding to give you a credit limit increase, the bank again has two questions: whom to give. So who are the borrowers to whom I should give the credit limit increase? That's one. The second is by how much of an amount should I be giving a credit limit increase to the borrower? How much of an account should I be giving the credit limit increase? That is another important part that I need to talk about. So when I am discussing or when I talk about this part, so let's see how this happens. So basically, the first question is, so for CLI, so if I am going to give a credit limit increase, the first part, the first question that we answer is who to give and how much to give. how much to give. So basically, who to give the credit limit increase and how much to give the credit limit increase, right? So who do you think I should give a credit limit increase? So if I have 1,000 borrowers, what should be the matrices according to which I should assess that how much or who are the borrowers out of this that I should give a credit limit increase to? Okay. So basically, the first thing is I should be giving, before going for the less risky or more risky, the first thing I should look into is that I should give the credit limit increase to the borrowers who are active in nature, who are active. Because an inactive borrower who has taken the card and never used it is also a less risky borrower because he has not used it. So I do not have any risk from him as of now. So there is no point in giving that guy a credit limit increase because he just keep his card idle. So it might be that he holds his card for some reason, but he never uses his card, right? So that is where this so that is where active borrower becomes important. So I'll have this active borrower, so whoever the active borrower is. So first of all, I should choose those borrowers who are active. Now within active, there would be two groups of borrowers. One is the risky borrowers, and then is the less risky borrowers. Now, mostly the risky borrowers, the borrowers who are relatively of higher risk, are those borrowers, I mean, those borrowers who are relatively higher risk would be given simply a credit limit decrease. Their limits would be either decreased or they would not be given any limit increases. There is less risk. Now, the next part that I have over here is, now within the less risky borrowers, I would look into the borrowers by their utilization. So whoever has a higher utilization is something who would be given the credit. Who has a higher utilization. So there are, I would divide my, you know, high and low. So basically, before giving a limit increase, right, I also need to understand how much of the limit increase should I be giving. So over there, I would divide the less risky borrowers by their utilization. Utilization high, medium, and low, or with utilization high and low. The utilization high and the utilization low. Now, for the higher utilization borrower, I will look into that who has a relatively higher payment balance ratio and who has a lower payment balance ratio. Within the lower utilization, I'll check whoever has a higher purchase or a lower purchase or something like that. And then based on that, what I'll do is I will give them, I'll allot my credit limit increases. And now over here, to understand this less risky and the more risky borrowers, it is this part that the behavior score is actually used. This is where this score is used. Behavior scorecards. Use behavior scores. Clear? And this entire approach of CLI or a CLD, as we talk about, is, I mean, this follows a entire segmentation approach. So there are, so by creating appropriate segments based on the different variables, we can actually identify, we can allot the percent of credit limit increases that we want to give to different. Clear? Great. Now again, this behavior score, and to decide upon the less risky and the more risky and all, so that is where the behavior score plays a very critical role, right? So it helps you in dividing the segment and who is a more risky, I mean high risk, low risk, medium risk borrowers. Right. Now having said that, again the next part that we'll talk about over here is the following. Then what are the other uses that behavior scorecard has? How can I use behavior scorecard for different parts, for different activities? Now, apart from these business strategies, right? So it is also used for as a recession combat or downturn combat strategy, or as a recessionary strategy to control credit, or the secondary lines of credit during the recession, right? So, appropriately adjusting the cutoff behavior scores, I by adjusting the respective cutoff scores, uh, we can adjust the different policies. Combat stationary combat strategy. So by appropriately adjusting the cutoff behavior score, I can always control the secondary line of credit increases that are going out to the borrower. So during recession times, what happens is I say that okay, with so and so behavior score, there would be no credit up to so and so behavior scores. There would be no credit limit increases. Only the people with the highest behavior score decides will get the credit limit increase, and hence in that way I'm just channelizing out the higher credit limit increases to the best possible borrowers, right? So okay, this is how this particular thing actually happens. So also, for to combat recessions, what one can do is that they say that okay, for so and so behavior scores, so behavior scores say for between 700 to 750, the time period between which two credit limit increases, between two successive credit limit increases will be 6 months, at least 6 months. However, for credit limit increases, however, for scores between 750 to 850, the time gap between two credit limit increases can be just 4 months. So basically, by doing this kind of a thing, they might control not only the volume of the credit, but the next levels of credit limit increases. So one is by increasing the credit score or the cutoffs, what you are doing is you are removing a relatively risky portion of your borrowers from credit limit increases. The second case, what you are doing is you are actually within your best borrowers, you are again granularizing them, and you are adjusting for the third round of secondary credit limit distribution. So you are saying that okay, now for these people with scores greater than 700 up to 900, I am giving them credit limit increases now. But the next round of credit limit increase will be highest. So between for 700 to 750 uh, behavior score, they cannot apply credit in the next 6 months. For 750 to 850, they cannot do it between the 4 months. And between the others, and for the others, it's like 850 to 900, they can do it they cannot do it before the 3 months. So basically, when the next round of credit limit happens, the next round of limit would be given only to the best possible borrowers, then to the relatively worse of, and then to the relatively worse, and then to the worst of borrowers within the best possible borrowers. So by adjusting for the time gap between the two differential states, we can always control the credit policy. So over there, the bank is actually creating some future growth opportunities, but regulating it as well. And they can all do it by playing along with the bar set for by the behavior scorecard, by the behavior scores. And that is where the behavior score for credit cards become very important. I mean, this is not only for credit cards, this way behavior scores also become very important for you know uh, for the others as well, for other, right? So this is how it actually happens. Clear? Okay, great. So Harpreet, will stop here for the time being, right? Because I believe you also have work to attend. So we'll start off from 7:30 tomorrow, and I'll share the link by
Okay.
7:50, right?
Okay. And can you please share the link of the recordings as well?
Yeah, I'll share the link of the recordings.
Okay.
uh,
Thank you.
okay, bye bye.
Bye.